I mean, people aren't bringing it up nearly enough. They fail to grasp the magnitude of the story. They are completely bewildered as to the reasons behind the recent price increase of gold, what it may indicate, and why the public should be alarmed by this development. I don't see enough news coverage to worry that it might be too popular and that I should sell it. Plus, I believe that once gold prices reach 4,200 tln or 4,300 tln, it's possible that they won't bring it up again until it reaches $5,000, correct? I mean, it's not like the topic at hand is really important. Perhaps when it reaches $10,000, they will begin to give it more daily attention. Due to monetary expansion, printing money, and unsustainable debt, the US dollar is intrinsically vulnerable to fall. According to him, the decline of currencies is more important than the increase of gold. As the value of paper currency declines, the price of gold rises. As he sees it, the inevitable result of severe and long-lasting monetary degradation is prices of $10,000 Oz and beyond, not a speculative bubble. Sustained inflation and the failure or reluctance of central banks to limit the development of the money supply are key points in Schiff's case for a potential advance toward $10,000 or even higher. A rapid depreciation of the dollar's purchasing power may occur sooner than anticipated if inflation persists, and real interest rates, which are adjusted for inflation, remain negative or weak. Institutions and investors may seek safety in tangible assets, such as gold, at these times. Schiff frequently argues that the momentum of gold could feed on itself once a tipping point is achieved. An increase in the price of gold increases demand, which in turn drives up the price of gold even more. His position is further supported by the enormous and ever-increasing US government debt and the accompanying interest payments. Government funds are increasingly going toward debt servicing instead of investing in productive areas as the national debt increases. To deal with debt, the government might use monetization strategies like money printing, implicit or explicit, according to Schiff's warnings. That has the potential to devalue the dollar even higher, which would lead more people to seek safety in gold. If that were to happen, he would not consider a price of $10,000 or more to be an extreme case, but rather a potential turning point in the long process of re-evaluating gold relative to fiat currency. To make sure you get timely updates, subscribe to our channel and turn on the symbol before we continue talking about this. Please enjoy the video and thank you. In the past, there have been many short sellers in the silver market. Now, when they attempt to influence prices, they do so through the futures market. Perhaps the shorts are attempting to lower prices by selling futures, but their strategy is failing due to the high level of physical demand for the commodity at the moment, which means purchasers are unwilling to wait until December to make a purchase. That, in my opinion, is a surefire indicator that the market is about to undergo some changes. As a result, I predict that serious buyers of silver, who are willing to wait a few months, will start to consider purchasing futures contracts instead of buying silver now, with delivery scheduled for December, as the shorts begin to lose control of the market. The silver is unnecessary for me. No, I am not going to use it to create batteries. I simply desire it for investment purposes, so I will patiently wait a few of months to receive it. If many people who purchase these future contracts end up not completing them when the time comes, that might be a major issue. If they are short a certain number of contracts, the exchange will notify the party on the opposite side of the contract that they need to deliver a certain number of bars of silver. This forces the futures trader to purchase silver from the physical market since he does not yet have any on hand. Most sellers in futures contracts are essentially speculators betting on a price decline. The exception to this rule would be a miner who is hedging. Even if they don't currently possess the silver, they will need to purchase it in order to fulfill the delivery. The influx of futures traders necessitating silver purchases has boosted demand in the spot market. This could detonate at any moment. Because buying yourself out of a short position is the only way out if you don't want to deliver, there might be a huge surge of short covering. However, someone will have to deal with the delivery notice, because everyone with a futures contract can take delivery. In my experience, there has been an uptick in business, but it hasn't been very noteworthy. This is, of course, emanating from the lowest possible echelons. Few people are interested. In 2020, the COVID year, Shift Gold had the best year that I have owned or been engaged with. In the early days of COVID, many people hurried to purchase gold and silver. Despite a considerably larger surge in price, we currently have nothing comparable. Actually, this is the largest rally to yet. Gold prices have risen by almost 57% year to date. Not since the 1970s have we experienced such a monumental year. Additionally, the 1970s were a time of large gold price fluctuations, but none have occurred since. We should be having a booming business, right? It's the best year since the 70s, so you would think so. The fact that it is still early is encouraging then. There has been absolutely no retail purchase surge that we are aware of. However, I do believe that if you look at the news today, you will see some coverage of gold, which is better than none at all. Consequently, the fact that gold is now at $4,000 became a talking point. However, they ought to be discussing it more. They fail to grasp the magnitude of the story. They don't understand the logic behind the gold price increase, what it could signify, or why the public should be concerned about it. I don't see enough news coverage to worry that it might be too popular and that I should sell it. I mean, once gold prices reach 4,200 or 4,300, who knows? Maybe they won't bring it up again until it reaches $5,000. You know? I mean, it's not like the topic at hand is really important. Perhaps when it reaches 10,000, they will begin to give it more daily attention. However, Bitcoin inevitably comes up whenever gold is brought up, even today. This means that gold doesn't even receive a mention in the news. At all times, it must take a back seat to Bitcoin. That will change though, when the price of gold continues to rise and Bitcoin falls in value, exposing the digital gold concept for what it is, a marketing ploy. Nonetheless, I believe the retail industry is in its infancy. After years of underperformance compared to stocks, Wall Street is only now beginning to recognize gold. The idea that our clients might benefit from exposure to gold is finally beginning to be considered. The most prominent example, according to Morgan Stanley, of a 60-40 portfolio that should be 60-20-20 is to decrease your bond holdings in half and invest the other half in gold. In my opinion, that is a huge improvement for Morgan Stanley. However, if clients of brokerage firms nationwide are planning to sell half of their bonds and purchase gold, it indicates a significant amount of purchasing is imminent. Having said that, $10,000 isn't typically presented by Schiff as an assured short-term objective. He says it's more likely to be true in very unlikely but not impossible scenarios. For example, he recently stated that, due to the dollar's prolonged decline, gold is unlikely to remain above $10,000 and may perhaps reach $20,000 or even higher. His main point is that $10,000 is more of a potential floor than a ceiling. Additionally, he has noted that changes in US administrations or other political or policy factors could hasten the process. He had previously hinted that, under Harris's government, the price of gold may skyrocket to $10,000 in an interview. Still, you should think about the key cautions and criticisms. there would likely have to be a confluence of several enabling factors for gold to really hit $10,000. Continual depreciation of the dollar, persistently low or negative real interest rates, dwindling faith in fiat currencies, and potential strain on international monetary systems. Such a scenario is considered extreme by many observers and highly implausible for the near to medium future. Markets also factor in a lot of expectations beforehand, and asymmetrical thinking can show itself in quite extreme predictions. If the scenario plays out, the payoff would be enormous, but there's also a good chance that it won't. We began the 1970s in 1971 by abandoning the gold standard. As a result, we were able to print more money and run larger deficits since we were no longer restrained by gold. We let go of those constraints, allowing the government more leeway to act recklessly. Consequently, the dollar's value plummeted in the 1970s. Because of this, the price of oil jumped from $3 per barrel to $40 per barrel. We advanced the idea that OPEC was to blame. You are taking advantage of us by driving up the price of oil. The United States, however, attempted to pull OPEC over by paying them in paper currency rather than gold. We could obtain $3 per barrel of gold when we exchanged it for their oil. We were ready to pay in fiat currency, but the price per barrel was $40. It's not their fault that we attempted to take advantage of them, but the cost of everything increased. The value of the dollar plummeted. Considered a major event. Actually, many women had to find jobs in the 1970s, since their husbands' wages were worthless due to the massive amount of money that the government produced. As a result, they were unable to pay their bills in the 1960s, so they had to wait until the 1980s to work. Therefore, I anticipate that the second part of this will be comparable to what we are about to go through. Thus, the world remained on the gold standard even after we abandoned it. Dollars were their currency of choice. They merely made a note of it, but they continued to use it. At this point, they will label it. The world is finally going to admit that we're leaving the dollar standard, in my opinion. The time to do it is now, even though we ought to have done it 50 years ago. What this implies is that the dollar is being exchanged for gold by all these foreign central banks. What this also implies is that nations aren't trying to get dollar revenue by running trade surpluses with the US. They won't be interested in purchasing US Treasury bonds if the demand for dollars decreases. Our mortgage-backed securities are unnecessary for them to purchase. Furthermore, we are quite isolated. Given that we would not be able to import as many items from other countries, consumer costs are going to be significantly higher. There will be far higher interest rates because the rest of the world will not lend us money if we borrow it. It will be necessary for us to borrow it from fellow Americans. Not to mention that the majority of us are severely underfunded. Everyone is borrowing. We are unable to lend money to one another. Since the Chinese save half of their income, we can borrow from them. Many Americans blow over their entire paychecks and then some. Everything has been used up. Listen, you might be in for a harsh shock. In my opinion, however, the dollar is about to undergo a precipitous fall that will surpass that of the 1970s. It was a decrease of around 2/3, but I have no idea how much longer it will take. In my opinion, the gold price may follow a comparable pattern. From $35 to $850, gold surged up. Calculate that percentage increase. The $4,000 gold price is just the beginning, though. You do realize that deflation in terms of gold is here to stay? Gold is solid currency. Excellent response. Sure, I can help you out. Then it has transpired. Listen, at its 1999 high point, The Dow Jones was worth 45 Oz of gold. As of right now, it's worth 11. That's a decrease of 75% in just 26 years. Deflation like that is significant. In fiat terms, however, the Dow has increased fourfold, so it is hard to tell. It has dropped significantly when measured in actual currency, though. Furthermore, it will persist. In my opinion, the housing market will also undergo a similar transformation. The apparent thing is that home prices have fallen in relation to gold. Exactly how many ounces of gold would be required to purchase a home is something I have not calculated. Real estate might be at an all-time low. Home buyers in this country formerly had to put down gold to secure their deals. Purchasing real estate during the era of the gold standard was done with gold. That was the price they were sold for. The result is that prices will drop across the board. However, issues arise in a fiat economy when, in principle, an endless supply of zeros may be printed on bills. In spite of a decline in the item's actual worth, they can manipulate prices to increase. So, I don't think we're going to experience deflation in the conventional sense, where items that cost $100 today will only cost $90 tomorrow. Yes, tomorrow it will cost you $200. However, those dollars will have far less purchasing power in the future. Therefore, certainly when it comes to precious metals like gold and silver. If you have gold or silver on hand now and plan to use it in a year, 2 years, 3 years, or 5 years, you can buy more with less gold. To purchase whatever it is you require, you will not be required to spend as much of your gold. Peter Schiff's long-term gold thesis had a chance to materialize on a grand scale by the early 1930s. Since interest payments consume a record portion of the federal budget and the US debt reaches $40 trillion, his theory that huge debt, unending fiscal deficits, and central bank money creation will destroy confidence in fiat currencies becomes more and more probable. There is a possibility that the once uncontested reserve currency, the US dollar, will start to lose ground as more countries start trading oil, technology, and commodities in alternative currencies. There will be a greater demand for gold as a neutral, borderless store of value when the dollar's demand falls around the world. In Schiff's scenario, a number of reinforcing shocks occur between 2026 and 2030. A growing wealth disparity caused by asset inflation, increasing geopolitical unpredictability, and inflation that persists despite interest rate hikes. If central banks wanted to become less reliant on the dollar system, they would probably speed up their gold acquisition, especially in developing nations. By that point in time, central banks may be buying more than 2,000 tons of gold every year, which is twice the current average. A vicious cycle of increasing demand and decreasing supply can ensue if retail investors who are seeing their faith in digital assets and fiat savings erode decide to follow suit. Leave a comment with your opinions, subscribe to the channel, and like if you thought this analysis was helpful. More individuals who should hear these important conversations will hear them thanks to your participation.